Billions in market value vanished in a few quarters. Not over a decade, not slowly, quarters. Real money, real collapse. Just months ago, these same companies were on stage, on earnings calls, and in commercials telling you demand was strong, telling you pricing was justified, telling you the market had reset. They spoke down to buyers like the pain was imaginary. Now look at what's happening. Those same cars are being dumped at clearance level pricing. Inventory is being shoved out the door. Dealers are advertising like it's a liquidation event. This isn't subtle. This isn't hidden. This is what panic looks like when it leaks into public view. And let's be clear before anyone tries to spin this. This is not a cycle. This is not a correction. This is not smart temporary strategy. When you see incentives stacking on top of incentives, when you see employee pricing handed to everyone, when you see vehicles sitting so long they start costing more to hold than to sell, you're not watching confidence. You're watching desperation. And the last brand on this list makes the rest look stable by comparison. That's not hype. That's a warning. This story isn't about bad cars. That's the distraction they want you arguing about. Features, reliability, trim packages. None of that explains what you're seeing. This is about a system that overreached. Prices were pushed far past reality. Monthly payments were inflated beyond sanity. Financing was stretched until it snapped. And when buyers finally said no, the industry didn't take responsibility. It blamed you. They said you were being unrealistic. They said you needed to adjust expectations. They said this was the new normal. That was the lie. Because demand didn't disappear. The math did. When a market depends on people accepting payments they can't justify, trade-ins that no longer exist, and interest rates that punish every signature, it isn't strong. It's fragile. And fragile systems don't bend. They break. What you're watching now is the fallout from years of manufactured confidence, artificial scarcity, price padding, loyalty abuse, the assumption that buyers would absorb anything as long as the badge stayed familiar. That assumption is dead. What broke wasn't interest in cars. People still need transportation. What broke was trust. And once trust goes, pricing power collapses with it. Fast, brutally, publicly. The auto market wasn't built to handle resistance. It was built on compliance, on the idea that buyers would keep swallowing increases quietly. That game is over. This market didn't stumble. It snapped under its own weight. And the behavior you're seeing right now is not recovery. It's exposure. Next, you're going to see exactly how the system broke from the inside. Not theory, not charts. Real-world behavior that proves this collapse was baked in. Sticker prices exploded. Wages didn't. That gap mattered more than anything else. Monthly payments didn't creep up. They doubled, quietly at first, then all at once. Buyers didn't lose interest. They lost justification. That's when incentives came back. Not as promotions, not as rewards, as pressure valves, cash on the hood, special financing banners, loyalty bonuses stacked on top of fake urgency. When incentives return this fast, it's not confidence, it's damage control. Dealer lots filled up again, not with excitement, with inventory rotting in plain sight, rows of vehicles sitting longer than planned, longer than profitable, every extra day turning metal into liability. Then trade-ins collapsed. Values fell out from under buyers mid-negotiation. Equity vanished. Payments jumped again. Repeat buyers froze. First-time buyers walked. The pipeline clogged. Financing turned hostile. Rates spiked. Approvals tightened. Lenders stopped pretending risk didn't exist. Foot traffic thinned out. Not because people stopped needing cars, but because the deal stopped making sense. Dealers didn't pivot. They panicked. Prices started dropping quietly. Then publicly. Ads multiplied. Emails got louder. Calls got more frequent. Limited time offers that never expired. Sales language shifted from confidence to urgency. If you're paying attention, you've already seen it. The non-stop ads. The sudden friendliness. The pressure disguised as opportunity. None of this is strategic. None of this is planned elegance. These are stress responses. Markets under control don't behave like this. Strong systems don't beg. They don't contradict themselves week to week. They don't need constant noise to move inventory. What you're watching is a system reacting, not leading, responding, not steering. And when behavior changes this fast, it means the failure already happened. You're just seeing the symptoms. Now it's time to stop talking about the system in theory, because the proof isn't abstract. It's sitting on dealer lots with price tags peeling off. Nissan comes first because it shows the early fracture. This brand was built on affordability, on normal people buying normal cars without games. That was the promise. Then prices drifted upward, slowly at first, quietly, while buyer reality stayed put. Wages didn't follow. Payments did. Now incentives are everywhere. Not subtle ones, big ones, loud ones. Dealers are sitting on aging inventory, watching foot traffic thin out, waiting for buyers who don't show. What looks like generosity is actually pricing control breaking down. When a brand has to keep correcting itself in public, the damage is already done. Mazda is a different kind of pressure. This was a brand known for discipline, smart value, tight execution. It didn't chase everything. That restraint was the advantage. Now it's chasing premium margins without premium scale. That's a dangerous mismatch. Dealer confidence weakens when pricing power isn't backed by volume. The brand stretches beyond its natural limits, and the tension shows up on the lot. This isn't ambition. This is survival pressure in a market that punishes small mistakes fast. Subaru held out longer than most. Loyalty protected it, reputation carried it, reliability stories did a lot of heavy lifting. But those narratives are getting louder, messier, harder to defend. Doubt doesn't arrive all at once. It leaks in. Dealers quietly sweeten deals, not because they want to, but because they have to. The image still stands from a distance, but up close, the foundation is cracking. Loyalty only works until buyers start hesitating. Ford shows what happens when size turns against you. Scale once meant stability. Now it means crowded lots, massive exposure, and blunt incentives just to keep metal moving. High MSRPs ran straight into financing reality, and the math failed. Margins eroded fast. Publicly, you can see it in the pricing swings, the incentives, the urgency. When a company this large starts blinking, the message spreads quickly. Chevrolet doesn't look broken at first glance. It looks busy. Too busy. A lineup so wide it can't explain itself. Overlapping trims, overlapping segments, overlapping messages. Buyers slow down because clarity disappears. Dealers compensate with deals that scream uncertainty. Confusion turns into hesitation. Hesitation kills volume. This isn't about bad vehicles. It's about a brand that lost control of its own story. GMC tried to live above the fray. Premium positioning, higher pricing, familiar hardware with a nicer pitch. Buyers started asking uncomfortable questions. Why does this cost more? What am I actually paying for? Discounts creep in to defend an expensive identity. Premium pricing collapses the moment trust weakens. And once that starts, it's hard to stop. Then there's Cadillac. This was supposed to be confidence, authority, clarity. Instead, it swings between tech promises and legacy confusion. The message changes faster than buyers can process. Incentives replace prestige as the main selling tool. That's not weakness. That's existential erosion at the top. When a luxury brand leans on discounts, the signal is unmistakable. At this point, the pattern isn't debatable. Different brands, same pressure, same behavior, same outcome. The verdict is already forming. You can feel it. The old automotive rules are dead, not fading, not evolving, dead. Loyalty no longer protects brands. Reputation no longer holds price. The badge stopped being a shield. Buyers were told to trust the name, to accept the increase, to swallow the payment. That trust is gone. Pricing power is gone. Confidence is gone. And for the first time in decades, the buyer can see the leverage shift. Not because buyers suddenly became smarter, but because the system became obvious. The numbers stopped lining up. The excuses stopped working. The pressure leaked into public view. What's happening now is structural, not reversible, and not gentle. This isn't something a rebate fixes. This isn't something a marketing campaign patches over. When trust erodes at this level, it doesn't snap back. It collapses forward. The next phase will be louder, cheaper, more desperate, more visible. You'll see bigger discounts, harsher messaging, faster reversals, not because brands want to, but because they have no room left. If you've seen this pressure at a dealership, say it. If you haven't yet, you will. This channel exists because the system won't tell you the truth. And the truth is simple. What comes next will be worse.